So you've seen the ads everywhere, right? Trade stocks for free. No commissions, no hidden fees, absolutely no catch. It sounds pretty revolutionary, doesn't it? But, like with most things that sound a little too good to be true, there's always another story happening behind the scenes. So let's ask it straight up. Can you really trade stocks, options, and even crypto without paying a single cent in commissions? That's the billion-dollar promise from these apps that have completely, and I mean completely, reshaped the entire world of investing. Well, the short answer is not exactly. Today, we're going to pull back the curtain and show you exactly how these free trading apps have built these incredibly profitable businesses, all while you think you're not paying them a dime. Okay, let's dive into this. You have to remember, it wasn't that long ago that investing meant calling up a broker and paying some pretty hefty fees for every single trade. Then platforms like Robinhood in the US and Zerodha in India showed up with this totally radical idea. What if we made trading free for everyone?
And listen, this wasn't just a small change. It was a seismic shift. It was a revolution. They basically forced all the old-school companies to change their ways, and they opened the floodgates for millions of new, younger investors to jump into the stock market for the very first time. They really did democratize access to the financial markets.
But this, of course, brings us to the big, crucial question. These are massive tech companies we're talking about. They've got employees, servers, and, shareholders who expect to make money. So if the trades are free, where on earth is the profit coming from?
And this is where it gets really fascinating. Their business model is just a masterclass in modern finance. It's built on a bunch of different revenue streams that most users, probably you included, never even see, so let's break them down.
Okay, the big one, the absolute giant, especially in the US, is a practice called payment for order flow. You'll see it called PFOF. Now, this is the real engine behind that whole free trading machine, and it's also by far the most controversial part of their business.
So how in the world does it work? Well, it's a pretty simple three-step process. First, you decide you want to buy a stock, and you hit that button in your app. Simple enough. Second, instead of your order going straight to, say, the New York Stock Exchange, your broker actually routes it to a massive high-frequency trading firm, what's called a market maker. And third, that market maker completes your trade for you, and then pays your broker a tiny little fee for sending them your business. Now, this is where the debate really heats up. If you ask the brokers, they'll tell you this whole process creates a more efficient market for everybody. But the critics, they have a much sharper way of putting it. They just call it selling the customer's trades to the highest bidder. And you're probably thinking, okay, but how much can they possibly make? I mean, we are talking about tiny fractions of a penny on each trade. But here's the thing. When you take that little fraction and multiply it by millions of users, all making millions of trades every single day, well, it just explodes into a revenue stream worth hundreds of millions of dollars a year. But PFOF isn't the whole shebang. Nope. These platforms are smart. They have a bunch of other ways to make money. For instance, they earn interest on any cash you have just sitting in your account uninvested. They sell premium subscriptions, like Robinhood Gold. They charge you interest if you borrow money from them to trade on margin. And finally, they can bundle up and sell aggregated, totally anonymous data about what retail traders are doing to big financial firms. So this brings us to a much, much bigger idea. Because this isn't just about a financial model, it's about a psychological one too. It's all designed around the power of one single word. And that word, of course, is free. Free just gets rid of the barrier to entry. It makes you think, hey, what if I got to lose? It encourages people who might have been a little nervous to start trading, and it definitely encourages them to trade more often. And guess what? The more trades that happen, the more chances the platform has to make money through things like POF. See, it's not charity, it's just brilliant business psychology. This whole thing really blew up during the GameStop saga back in 2021, remember that? When platforms like Robinhood suddenly stopped people from buying certain meme stocks, users went ballistic. And it put a huge, glaring spotlight on this whole PFOF model. Critics were screaming that it created a major conflict of interest between the brokers and the very people they were supposed to be serving, the everyday traders. Yeah, that whole event really drove home a crucial truth about so many modern tech businesses, and it's captured perfectly right here.
When the service is free, you really have to stop and ask yourself who the real customer is. In this model, it turns out your trade itself is the product that's being sold.
But is this the only way it can be done? Absolutely not. And it's really cool to compare the US model with another giant in the space, India's largest broker, Zerodha. It just goes to show how different rules can create completely different systems.
So in the US, Robinhood's entire model is basically built on PFOF. But over in India, PFOF is actually illegal. So Zerodha had to build its business in a totally different way. They charge a very small flat fee. It works out to about 25 cents for certain kinds of trades, and then they make their money from premium tools and other services. See, two different paths to the same exact goal.
But for all their differences, they share that core Silicon Valley principle: get big first. Get millions and millions of users on your platform with a super compelling, super low-cost offer. And then you can figure out the best ways to make money off that user base later on.
So after all that, what's the takeaway? What's the actual real cost of free trading? Well, it really just comes down to a classic trade-off.
You know, it's one of the oldest rules in business, and it is more relevant today than it has ever been. Nothing is truly free. The next time you open up that app to make a so-called free trade, just remember that somewhere deep inside that complex system, a transaction is happening.
Which brings us to our final question, something for you to chew on. And look, there's no right or wrong answer here, but knowing how the system actually works lets you make an informed choice. So what do you value more? Would you rather pay a small, transparent fee for a trade? Or are you okay trading for free, knowing that your order itself is the real product being sold? It's a question every single modern investor has to answer for themselves.